Module 2. Crimes involving currency and money. Money laundering. Money laundering means the concealment of the existence, origin, nature, or source of money obtained illegally. Federal law prohibits money laundering partially because detecting financial crimes such as tax evasion, drug trafficking, and gambling operations can be difficult. Because these criminals typically want to spend their ill-gotten gains, they often try to convert them into what looks like legitimate money. Catching criminals trying to hide the source of their illegally gained money is often easier than proving the original crimes. There are numerous ways to launder money, such as smuggling cash offshore, depositing it into foreign banks, and then wiring it back to the U.S. to set up and fund legitimate businesses with dirty money, and then asserting that ill-gotten gains are profits from legitimate businesses. The federal money laundering statute defines the crime as when a person, knowing that the property involved in a financial transaction represents the proceeds of some form of unlawful activity, conducts a transaction to conceal or disguise the nature, the location, the source, the ownership, or the control of the proceeds of specified unlawful activity, or to avoid transaction reporting requirements. The seriousness with which federal law takes money laundering is reflected in its 20-year statutory maximum sentence, and a base offense level 8 levels higher than the theft of the same amount under the federal sentencing guidelines, and enhancements for people who are in the business of laundering funds. The necessary proof to obtain a money laundering conviction can be broken down into 4 elements. 1. The defendant must engage in a financial transaction. 2. The defendant must know that assets involved represents proceeds of illegal activity. 3. The money must in fact have come from certain specified illegal activities, such as fraud, bribery, smuggling, and many others. And 4. The defendant acted with the intent to promote or conceal the illegal activity or to avoid taxes or reporting requirements. The financial transaction element is broadly defined by the statute. It includes the movement of funds by wire, monetary instruments like checks or money orders, or money transfer services such as Western Union, or electronic financial service providers such as PayPal. Transactions also include transferring goods or titles to real estate, cars, etc. However, as with many federal criminal statutes, there is an interstate commerce requirement. That is, the activity must, in some way or degree, affect interstate commerce. As a practical matter, this is not difficult to show, as under the terms of the statute, the use of a financial institution that engages in interstate commerce is sufficient. In United States v. Campbell, Ellen Campbell, a real estate agent, was convicted of money laundering for assisting a drug dealer in purchasing a house with drug money. Campbell arranged for the seller to accept $60,000 in cash, representing a third of the purchase price. The large amount of cash used by the buyer, Campbell's admission that she knew that the money might have been drug money, and other circumstantial evidence was sufficient to justify the inference that Campbell knew that the transaction was designed to legitimize drug money by converting it into real estate. This case illustrates that knowledge of the illegal source of the funds can also mean willful blindness to the source. Regarding the third element, that the money must be derived from illegal activity, in United States v. Venanzi, the defendant successfully challenged a money laundering conviction when he had not yet received the proceeds of his illegal scheme when he made that transfer that prompted the money laundering charge. Because he had not yet received the money, it was not criminally derived property, even though the laundering transfer may have been made in anticipation of its receipt. Note, though, that transferring from an account that holds commingled clean and dirty money can still constitute money laundering. As long as dirty money has been put into an account, any transfers of money from that account to conceal it, avoid reporting it, or any laundering activity can be money laundering. Counterfeiting. The Federal Criminal Code devotes an entire chapter to counterfeiting and forgery. The code makes crimes of counterfeiting and forging a variety of items, including currency, securities, postage stamps, license plates, legal documents, and more. Forging or counterfeiting an obligation of the United States, such as money and savings bond notes, is punishable by up to 20 years in prison. The same is true for obligations of foreign governments. Moreover, forgery and counterfeiting statutes define these terms much more broadly than the creation of the documents. The crimes also apply to dealing, possessing, and passing these fraudulent documents. To be guilty of counterfeiting or forging, the defendant must know of the counterfeit nature of the instrument. This can, however, be proven by circumstantial evidence. For example, in United States v. K, the Second Circuit ruled that knowledge of counterfeit could be imputed to the defendant who bought and sold counterfeit bonds, based on the low price at which the defendant was offered the bonds, the fact that the seller did not claim to own the bonds, defendant's contradictory statements, and the defendant's own statements which indicated willful blindness toward the nature of what he was buying and selling. Tax evasion and fraud. The crime of tax evasion is governed by the Internal Revenue Code rather than the United States Criminal Code. However, tax fraud can also constitute defrauding the United States, which is a crime under the Criminal Code. The most common type of tax fraud is filing false returns that underreport income, or overstate or plainly lie about deductions. There is also evasion of payment, which occurs after the tax deficiency has been established. This is usually committed by hiding assets so that the IRS cannot get a hold of them. This can be tax evasion whether or not the IRS has formally begun collection efforts. Tax fraud requires the willful attempt to evade or defeat the payment of owed taxes. Tax fraud is a specific intent crime, and so it requires knowledge that the tax is due and intentional steps to evade it. Moreover, it requires an affirmative act to avoid taxes. A mere act of willful omission does not constitute tax fraud. Merely failing to file an income tax return, in fact, is not felony tax fraud. It's a separate crime which we'll discuss momentarily. However, failing to file combined with any one of a number of actions can be tax fraud. These include filing a false W-4, which is a tax withholding statement, giving false statements to IRS agents, and diversion of corporate funds that should have been used for corporate tax payments for personal uses, concealment of bank accounts or any other hiding of assets to make them less visible to the IRS, and structuring transactions to avoid reporting requirements in order to make them less visible to the IRS. While civil penalties and interest may be applied to any tax deficiency, most federal circuit courts require the government to show a substantial tax deficiency to constitute tax evasion. While it's not always clear what a substantial tax deficiency means, for purposes of IRS penalties for understatement, an understatement of 10% of one's income is considered substantial. If a smaller understatement than that is not subject even to a monetary penalty other than interest, it seems unlikely that it would constitute felony tax evasion. Still, if the taxpayer takes affirmative steps to hide or conceal money from the IRS, there is no strict minimum to what could constitute tax evasion. While failing to file is not strictly considered tax fraud under Section 7201, Section 7203 of the Internal Revenue Code establishes a separate crime for willful failure to file a return, supply information, or pay tax. The statute imposes the duty to file on any person required under this title to pay any estimated tax or required by this title, or by regulations made under the authority thereof, to make a return, keep any records, or supply any information. And it provides for a punishment of a year in prison, a fine of $25,000 for an individual, or $100,000 for a corporation, and to be assessed costs of prosecution. While individuals are, of course, required to file their own tax returns, corporate officers with sufficient control of their companies have the same obligation with respect to the companies. For example, a president of a company, who is also its sole shareholder and operating officer, and who never delegated the responsibility to file to another employee or director, was criminally responsible to file all required tax returns. Like tax fraud, failure to file is a specific intent crime. Good faith misunderstanding of law, or good faith belief that one is not violating the law, negates willfulness, whether or not the claimed belief or misunderstanding is objectively reasonable. Still, intent can be inferred from the circumstances. From a Seventh Circuit case, United States v. McCabe. Quote, where evidence justified findings that the defendant knew the law required him to file returns, and that he deliberately failed to file without justifiable excuse, such failure necessarily prevented the government from knowing the extent of his tax liability, and his intent may be inferred. These elements, taken together, amounted to willfulness. Moreover, a person can be guilty of failing to file, even if, ultimately, he owes no income tax. Making false statements to the IRS for purposes of concealing unreported income is punishable as tax fraud under Section 7201, and potentially also under Section 1001 of the Criminal Code for making false statements to federal officials. Thus, the same action may be charged under both laws, though they would normally be assessed concurrent sentences, especially when based on the same statements. Signing a false corporate return that will ultimately reduce or underreport the income tax of the shareholder who is preparing the return constitutes two distinct crimes of evasion of personal income tax and subscribing a materially false corporate income tax return. Ponzi schemes. If you were one of the thousands of people and organizations who invested in Bernard L. Madoff investment securities in the 1970s, 80s, 90s, or even as late as the fall of 2008, you were probably happy with its services. You consistently earned high returns, about 10% annually on average, and your portfolio kept growing even when the market and the economy suffered. Moreover, when you asked to withdraw some of your funds, your request was handled easily and expeditiously, and you got your check in a few days. Unfortunately, though, the statements you got were lies. Your investment funds hadn't actually been invested, hadn't grown, and your growing securities account balance was merely a figment of Bernard Madoff's imagination. Madoff was, of course, running a Ponzi scheme. While Ponzi schemes may differ from incident to incident, the essence of a Ponzi scheme is when an investment manager lies to induce investors to give him money. He then takes money from new investors to pay off withdrawals from old investors, and repeats the cycle. The cycle depends on generating enough new money to pay off withdrawal requests. Madoff's scheme fell apart when, in the wake of the 2008 economic collapse, too many of his investors sought to cash out. Madoff didn't have enough money to pay these withdrawal requests, and he was left with no choice but to confess his scheme. He was eventually sentenced to 150 years in prison, and caused billions of dollars in losses. Madoff, of course, didn't invent the Ponzi scheme, and is not the first person to go to prison for pulling one off. Charles Ponzi, the namesake of the scheme, lured thousands of investors to invest with him by promising 50% returns in 90 days on profits made from international reply coupons. Ponzi used the funds he acquired to pay off a few early investors in 45 days. He collected $20 million in all, but the scheme fell apart when he was unable to pay off later investors, and he was sentenced to 5 to 9 years in prison. Amazingly, he jumped bail and proceeded to Florida, where he bilked more victims out of thousands of dollars using a similar scam. Arrested again and released on bail, he unsuccessfully tried to flee the country. When he was caught, he served just more than 7 years before being released. A comparison to Madoff's 150-year sentence should serve to illustrate how our society's mindset towards financial scams has changed. In the mid-1980s, almost 20 defendants operated a Ponzi scheme using precious metals as the bait. They sold the promise that the price of the metals would be locked in at the time of the sale, and that they, the defendants, would purchase the metals immediately and hold them for the customers. In fact, the defendants diverted the money to undisclosed uses and delayed the purchase of the metal or failed to purchase it at all. When detected, the defendants faced a battery of federal charges, including fraud, money laundering, and racketeering. Currency reporting crimes. Banks are required to report currency transactions, including deposits, withdrawals, exchanges, and transfers, of more than $10,000, with some exceptions. The exceptions include transactions by the bank itself with its funds, government agency transactions, and publicly traded companies. These and other reporting requirements were originally established by the Bank Secrecy Act of 1970 and supplemented several times, including by the Money Laundering Suppression Act of 1994, the USA Patriot Act of 2001, and the Intelligence Reform and Terrorism Prevention Act of 2004. Willful failure to file the required reports is a felony. Moreover, willful can be satisfied by indifference or abject failure to be aware of or act on a reporting requirement. In 1987, the Bank of New England was convicted when it failed to report a series of transactions in which its tellers were presented with multiple checks simultaneously that were each under $10,000, but which totaled more than that amount. The depositor did this several times and was given more than $10,000 each time, yet the bank never reported the transactions. Evidence showed that the employees discussed the issue, but that nobody followed up. The court ruled that knowledge obtained by corporate employees acting within the scope of their employment is imputed to the corporation, and that a corporation cannot plead innocence by asserting that the information obtained by several employees was not acquired by any one individual, who would then have comprehended its full import. Rather, the corporation is considered to have acquired the collective knowledge of its employees, and is held responsible for their failure to act accordingly. Moreover, federal law makes it a crime to structure transactions to evade reporting requirements. This includes intentionally structuring transactions in stages so as to make each of them less than $10,000 to avoid the reporting requirements, a practice known as smurfing. While, like most crimes discussed in this module, structuring transactions to avoid detection is a specific intent crime, the 11th Circuit held that the required intent is to purposefully evade reporting requirements. The defendant may be guilty even if he had no specific knowledge that these smurfing tactics were themselves against the law. Other courts, though, have held that knowledge that the structuring tactic is illegal is required. The 9th Circuit held that knowledge of the duty not to avoid triggering reporting requirements is an element of the substantive crime. The 7th Circuit has also held that the government must show that the defendant knew of the relevant reporting requirements, that he structured his transactions for the purpose of evading those reporting requirements, and that he acted with the knowledge that his conduct was unlawful. A pattern of structuring tactics is sufficient to show intent. In United States v. McPherson, the 2nd Circuit held that a pattern of his structured deposits was sufficient to permit a jury to find that a defendant knew of and intended to evade currency reporting requirements. In that case, evidence showed that in 6 out of 7 consecutive weeks, the defendant went to 3 different banks on the same day to make identical deposits of $9,000 each. In our next module, we'll look at false statements and perjury, including the expansive and some would call infamous Section 1001, which makes it a felony to lie to a federal official.